Hey, what's going on, y'all? This is Patrick with Blue Heron Construction, and I want to give you some tips today on what you can do when looking and shopping around for a home insurance policy for your property. So let's get to it. I'm going to talk to you a little bit about a personal experience actually I had during this process. And as many of you may know or may not know, I've actually been in the business of doing restoration projects for a number of years, and I've gotten to understand what the insurance is looking for, what they're not looking for when it comes to restoration projects. And I also know what, policies are better policies for restoration projects and what policies are not so good to have for restoration projects as well. The fact of the matter is that when you're a homeowner, there's a lot of liability in owning that property. And at some point in time, you're going to have to repair or fix something caused by a flood, by a storm, by, something, debris, whatever it's going to be. And your home policy is going to need to hold up on in those times where you've been paying these premiums and now it's time for the insurance company to take care of you. So this is something that's happened to me actually very recently right now. So I currently have a policy with a company that is a 1% policy, all perils, that I pay a pretty good premium on. I pay about $1,200 for the whole year, which is really good for a 1% policy. Those are kind of hard to find right now. But basically, I had contacted my insurance company specifically about I'm working with a lender right now on purchasing an investment property, and they needed to see my insurance for the current property that I have right now that I own. And so when I asked for them to send me the insurance showing proof of insurance for that property, they also sent me a notice. The notice was about how they were going to increase my deductible rate from a 1% to 2%, and then increase my premiums by $500 extra to $1,700. And I think it's really funny because if I would have never said anything to the insurance company asking for proof of insurance, I would have never known that my premium is going to go up because they don't contact you. Maybe they send you a piece of mail or something like that, but they don't contact you saying, hey, we're going to let you know that your premium is going up and your deductible is going up. So, be aware of that. And they also don't send you something to sign saying, hey, this is an agreement saying that, initial here that you're okay with us raising your premiums and raising also your deductible amounts. So I got nothing on that. They also raised the property value to something absurd, which wasn't even like close to what the property value was at. So what I'm trying to say is the insurance company, they don't, all they're trying to do is make sure that their best interest is taken, that I'm paying them more money, that if they ever have to pay out a claim, they're paying out less than the claim, and that at the end of the day, I'm in the hole for it. And hey, it's a business. They're trying to make money. I get it, but at the same time, it's becoming more and more of a thing now. And so I want to talk to you about a few things, quick things, what you should be looking for when shopping for an insurance policy. The first thing you need to look for is you need to look for something called an RCV policy. That's the replacement cost value policy. That policy will take care of you um, for the payment of what your property is worth today. So again, I like to use roofs because we do a lot of roofs, we do a lot of other things, but roofs is just the easiest example when it comes to explaining the insurance process. So let's say that something damaged your roof right now, okay, and it was caused by a storm. Well, your insurance company will pay an RCV value, the replacement cost value of it, in today's dollars. So that means that that roof, according to them, the marketing price of it, they look at it and they say, okay, labor price is this, and material price is that. Well, it's $30,000 for that roof in today's dollars, then they're going to pay the $30,000 minus your deductible. So that's kind of what you want. What you don't want is you do not want an ACV policy. So if you have an ACV policy, you should probably look into that, seeing if it's possible for you to switch to an RCV policy. An ACV is an actual cash value policy. Now, what that is that they will it is worth what it was when you first bought the home or back when you first got it insured. So what I mean by that is that let's say you bought the home 10 years ago and the roof was only worth $10,000 back in 2010, let's just say a little over 10 years ago. Well, in today's dollars, that roof is no longer worth $10,000 to fully replace or, to get a restoration project onto it. It's now worth $20,000. Well, if you call in an insurance claim and because you had a storm that happened to your house and you have an ACV policy, the actual cash value policy will only pay out what it was worth when you first got the policy. So it really gyps you from the extra $10,000 you should have gotten minus your deductible. And so a lot of people will get really stumped on that where they call in a claim and they had a $5,000 deductible, and in this example, the insurance say, hey, we're going to pay out 10,000, but you have to pay your deductible of 5,000. So at the end of the day, you only get $5,000 to replace this $20,000 roof. And so guess what? Now you're paying the additional $15,000 or whatever you try to, get a good cash deal discount. Because now you're really not using much of insurance to get your roof replaced. You're having to, get a settlement from the insurance company of that 5,000, and then you have to go shop around and figure out who can do the job, a good job for you at a reasonable price. You don't want to be put in that situation. The difference between an RCV policy and ACV policy is usually about $15 a month. So, you know, that's that's pretty, significant. And actually, it can be a little bit more sometimes, but over the course of 10 years or so, where the likelihood of something to happen to your home gets higher and higher the longer you hold on to that property. It's probably not worth your effort going to an actual cash value policy because you want to save $100 a year, $200 a year. It's just not worth it. So first thing, you need an RCV policy. That's what you want. Secondly, you want to make sure that you find an insurance company with 1% deductibles. Now, here's the deal is that as time goes on, the 1% deductibles are becoming a little bit more rare to find. And when we first started, the deductibles were, $500, $1,000, deductibles, and now they've become percentage deductibles. Now we see as high as 5% deductibles, which means you might as well not even have like an insurance policy because they expect you to pay for everything. And it's really ridiculous. It basically becomes a catastrophic policy at that point in time. In my opinion, it should be illegal. This should be something that, homeowners and so forth should complain about to their respective, states and so forth, their insurance departments, and figure out like what they can do to right those wrongs. Because to me, it's just ridiculous to say, hey, you paid a premium, but we're not going to pay anything towards your house unless it's completely blown over. And even then, you're still responsible for 5% of the home value. So the way that the deductible works is that it's a percent of the home value that the home is currently worth. So if you own a $200,000 house, well, your deductible, if it's a 1% policy, you have a $2,000 deductible. So we make the math really easy for you. Now, if you have a 2% deductible, then that deductible becomes 4,000, and 3% it goes on and on. So it keeps on going up. Here's the issue that we're running into is property values keep on going up, the deductibles become higher over time, and you run into an issue where people have 2% deductibles and now their deductible is $14,000, right? So you got a $14,000 deductible, and let's say the roof was valued at $30,000. Well, you're paying for half the roof. Even though you've paid for your policy, you're paying for half the roof. You're not just paying the deductible, the way to play the game with the insurance company, you got to pay the deductible, and that's fair and all, but you shouldn't have to pay more than what you need to. Again, the difference between the deductible of a 1% and 2% is also around, $10, $15 a month. There's no reason why you shouldn't have at least a 1% deductible, all perils covered. That includes pipes, that includes, your roof, obviously, and it just includes everything, right? You want to have all perils covered 1%. So that's the next thing you should be shopping for, 1% deductible. You need to avoid policies with limited payouts as well. That's another step. Make sure that you don't have a policy where, hey, we have 1% deductible for everything except for pipes bust, where there is, a $5,000 cap. So if something happened to your pipes, and a $5,000 cap on that, we're only going to pay $5,000 at the end of the day for that, minus your deductible. You don't want that. That's the most terrible, thing you can do to yourself. I had a client who we had a freeze a couple of years back where the insurance company said you're only going to pay $5,000 for this, and they had over $50,000 of damage from all the busted pipes from this winter storm. And what happened was that I went to a lawyer. The lawyer at the end of the day could not get anything passed because in the policy, in the fine print, it said $5,000, for pipes busted. And so now they're in the hole over 50 grand to get everything done in the house. And you have to understand it has to be done because when the pipes bust, and it busted during the storm that left their house completely soaking wet in the Houston weather for, almost a week. And so in order to avoid having mold and contaminants inside the house, you had to tear out the walls, you had to tear out the floors, you had to tear out everything. And now you have to do a complete, basically remodel the house, which we are going to take care of them. But it's just not fair that the insurance company threw that little line policy in there. So again, avoid policies with limited payouts. And you need to make sure also the next step right here is to ensure the house what it's worth. And so if the house you bought it at, $300,000, then you should go ahead and insure your house for $300,000. We see the insurance companies always raising the amount that you should be insured for on your policy. So let me give you a great example of that. We actually had this happen the other day too. There's a friend that we know, and we inspected his roof, and he had damage on the roof, and he's like, "Yeah, let's go ahead and call a claim." Well, come to find out, he has a $300,000 house. He insured the house for $700,000. Okay, so that's over twice the amount that he needs to be insured for. And the insurance company told him it was a great idea when he got that policy on his house. They gave him a 2% deductible with a $700,000 value of the house, and the house is not valued that at all. So that means his deductible was $14,000 on about a $25,000 roof. So he is now going to be out of pocket, not just his deductible, but also 14 grand on top of it. The insurance company is going to come out on top of this because they're not going to have to pay much on it, and they'll get a new roof replaced, and they'll charge them, crazy amount of premiums. You don't want to fall for that. The honest truth is this, is that when you buy your house is being evaluated by an appraiser, by an inspector, and they're saying that this is the value right here of the house. You don't need to get it valued or insured for more than what the value that they've told you. And here's the reason why. The insurance company is not going to pay you out $700,000 on a $300,000 property. Okay, the insurance is going to come up there, and let's say your house completely blew over, from a windstorm, and it's all gone. The insurance company go out there and say, okay, let's see what the value of this house is, and they're going to write everything down in their pricing system. They're going to say, you know what, it's $300,000, so we're going to pay you $300,000, and you're going to tell them, hey, it was $700,000 I was insured for. They're like, yeah, you insured it for $700,000. That's great for you, but you know what? It's only worth $300,000, so we're not paying more than what it's worth because they're only going to pay what it's worth. So why try to insure your house for more than what it's worth? Me as a contractor personally, I actually insure my home 80% underneath the value of the house. And the reason why is because I know for me that if my house were to blow over or had a storm, take care of it, that I could build my house for 80% of the value because I know how to do it. I don't need the 100% of the value. But for y'all, I would say only insure what the value is worth on the house. Do not pay pay more than what or overvalue it from the insurance company, because the issue is that if you overvalue your property, insurance overvalues your property, that means your premiums become higher because they're going to say, okay, it's no longer a $300,000 house. Let's just say it's a $400,000 house. Well, you're paying premiums on a $400,000 house, even though it's not worth $400,000, so it's higher. And then your deductibles are higher as well. So if it's $400,000 and you have a 2% deductible, well, it's an 8 grand deductible rather than if you had a 1% at 300,000, which is what the value should be worth, that'd be a $3,000. That's a $5,000 difference in something very minute and small. So you want to make sure that you're not overvaluing, the insurance is not overvaluing your property. And if they are, you need to give them a call and tell them this is what the value of my property is worth, and you need to insure it for this amount. So the last thing you need to do, hey, you need to shop around, your current insurance. If you don't have the replacement cost value, you don't have a 1% deductible, all perils, that you don't have any limits on your policy, and then also that the policy is not overvaluing the house property. And if you don't have that, you need to look for an insurance company that go ahead and do that for you. Again, the mom and pop companies are the best companies to look for. Do not go after, big companies like Allstate, State Farm, AAA, Nationwide. All these guys that are big, they're not really going to take care of you when it's time to take, time to really do something. I'm not saying that they haven't for people. I'm just saying that from experience, when it comes down to calling a claim, they give you a rougher time than smaller guys like GeoVera or Homeowners of America or Lighthouse Insurance. These guys have been, no name companies. They've been great. They take care of people, take care of clients. They offer these type of policies. They don't try to jip you off when it comes to your payments. So that's what you're looking for when it comes to a policy. You might also run out of luck if for whatever reason you have a policy, you've had it for the last 10 years currently, and it is an ACV policy or 2% policy, because if you've had it for the last 10 years, that means your roof is usually over 10 years old, and most insurance companies aren't willing to negotiate anything when you have an older roof or older pipes, things of that nature. So you might be out of luck. You might have to pay the 2% deductible to get everything replaced. And my recommendation would be, once you finish getting everything taken care of, call in a claim. You pay the 2% deductible, unfortunately, or use that ACV policy to get something out of the insurance company. Then you can shop around your insurance company for a 1% policy, for the RCV policy, for the no limits on it, and also make sure that the property value is not overvalued, because at that point in time, you need to get what you can out of the insurance company, but they will go ahead and allow you to shop with them, because now you have everything brand new again. Once you called in the claim, you got everything done. So now everyone and their mom is going to want to talk to you. All the insurance companies are going to say, hey, we're going to give you the best deal, or we'll give you the 1%, because now I don't have to worry about that roof for the next 20 years. So that's kind of what they do to play their game. Again, you got to play according to the rules that are set currently. But again, hopefully these were some good tips for you. If you have any questions, please leave some comments below. I appreciate the time, and have a good one, right?